It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the CFPs on the program. With me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Last year was one of the best years in the stock market ever and one of the worst in the bond market. So what should you expect in 2022? What will be driving the markets? What will be the themes to be watching for? How should you position your money in the new year? We're going to be talking about all of that and more today on the show.
The Wise Money Show is about financial planning and having a process that you view all 6 areas of your financial life through and then update and adapt to make great decisions, to apply financial wisdom to your life. Investments is just one of the 6 areas of financial planning. We're going to focus on that today. If you have questions for the show, we'd love to hear from you. If you have questions or need help, we'd love to help as well. You can find us online, wisemoneyshow.com, and you can reach out to us right there on the right. You can call or text 574-222-2000. That's 574-222-2000. And then all over social media, that's where most engagement comes. YouTube, Facebook, wherever, doesn't matter. Just search the Wise Money Show and follow us there. Yeah, guys, it was one of the I don't really believe it. I feel like I need to pinch myself, but was one of the best years in the stock market ever when you look at the overall return for the stock market, quote unquote, S&P 500, nearly triple the long-term average, and yet the volatility was almost at record lows. Mm-hmm. And so you guys surprised at the market as we look back on 2021?
I am. I mean, and maybe many of our listeners will be too, because when you look at your own investment performance, we're talking about the stock market, but we're defining that as the S&P 500, which is it's the largest 500 companies here in the U.S. But the reality is that it was kind of a handful at the top that were dragging an awful lot of that performance. So no one invests in just the top 10 investments or top 10 stocks in the S&P 500, right? Yeah. Unless they're really gambling, really aggressive, speculative even. Mm-hmm. Most people hold a diversified portfolio, and when you add in other types of investments, all of that would have been dragging down the performance of the few at the top there. So it may not feel like it was the best investment. You may not have performed better this past year than any other year, but this, just looking at the S&P 500, it was up pretty big.
Mm-hmm. Yeah, it is very surprising, and having done this for 28 years, I feel it's unlike anything I've ever seen. And I think an important thing to understand about the S&P 500, when the S&P 500 is doing well, everyone wants to compare their investments or their portfolio to the S&P 500. Yeah. When the S&P 500, you could have looked in 2009 and you hadn't made a penny in 12 years. So when the S&P was flat over the last 12 years, looking back from 2009, no one wanted to compare their investments to that. Mm-hmm. They're like, well, I wouldn't compare my investments to that. Mm-hmm. And one of there are a number of factors that go into this. And I would, we're coming off of you have the year end, you see family and friends at Christmas and New Year's and birthday parties and this and that and the other thing, and you're talking to people. And there's a lot of kind of fear of missing out or playing the comparison game or feeling, and a lot of I've had a number of clients just reach out and say, hey, do we have the right strategy? Mm-hmm. That's the right question. Mm-hmm. That is the right question, because whether I participated in what happened last year or not, and at some point I'd like to get into the top 10 stocks in the S&P 500 basically make up 30% of the S&P 500. Yeah. And you say, well, wait a minute, 10 is not 30% of 500. Right. So what is going on there? And I think it'd be good to explain, but I just come back to, this is a show about financial planning. This is 1/6 of your financial plan, and this needs to be integrated into your financial life. But this is not your financial life.
Yeah, I'm so glad that you're saying that, Kevin, because the risk about having a show where we recap what happened last year in the investment world, you may inadvertently start being distracted by numbers and performance and things like that really don't matter. And this question of what should you be comparing your own performance to, it's not your neighbor. It's not the S&P 500 or any of the other metrics that we rattle off today. It is your own specific financial plan. Hopefully you have a path forward to the life that you've envisioned for yourself, then an ideal future out there that you're trying to achieve. And your investments are part of that. As you said, it's going to help fund that future. But the path forward for you is not 28% a year, right? It is based on your own performance, based on your own risk tolerance, what you need to achieve in your financial life. And you can only find that answer by looking at your financial plan, working with your certified financial planner and determining what your benchmark is, what your path is, what your standard to measure yourself against is. And these numbers, they're really just kind of a summary of what the various investments out there in the world did last year. You had some smattering, some mixture of them to help you drive towards your financial goals. But this is not necessarily the path that you should be comparing yourself to.
Yeah, it was all over the board. I would definitely agree that investors should not play the comparison game with the S&P 500 because you own more than that, and you should. You really should. Small caps were up, I think, 20% by March and finished the year only up 14%, which is interesting. International investments were up nearly 20% by June and finished the year only up 11%. Emerging markets were up 10% by June and finished the year down 2.5%. Bonds just got out of the gate on the wrong foot. They were down all year and finished down 1.54%. By the way, that's the fourth negative year ever in the bond market. The bond market was created, the index, if you will, was created in the mid 70s, and this is only the fourth time since the mid 70s that the bond index was negative. So S&P 500 really was the story, but it shouldn't be the story or the headline or whatever for your investment performance and investment comparison.
Yeah, there's always someone who can perform just a little bit better, right? So S&P 500 is what we're talking about. But yeah, commodities, or take real estate. Real estate was up 41% last year. Right. So, and that's not even talking about just what's happened in your own net worth because of the value of your home going up, for example. I mean, almost everything felt an appreciation last year. And we'll talk later about, what was driving all that. Well,
so Kevin, you want to get into a little bit of this market breadth issue that I think, so the S&P 500 made 70 all-time highs last year. That's second only to 1998 when there were 77 all-time highs. That's just one of several statistics where you can compare this market to what was happening in the late 90s. Market breadth is another one if you wanted to start maybe talking about that.
Well, if you look at and this is a jargon-free zone, so forgive me because there's a little bit of jargon here, but the S&P 500 is a market cap weighted index. So that means that the bigger the company, as far as their market capitalization, that's the number of shares times their share price outstanding. And if you said, well, Apple and Microsoft make up 11% of the S&P 500 because of the sheer size financially of those two companies. And so there was...
When you include Alphabet, Google, right? Facebook as well,
Tesla, Berkshire Hathaway,
Amazon,
the FANG stocks.
You get a distorted, a very heavy segment of the market there, but that area, those few stocks perform differently than the rest. We're going to talk about that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. You're at the Wise Money Show channel. Make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. If you like the content, What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time, every Saturday morning, also on podcast wherever you listen as well. and a few radio stations in our local area here. So that's why it's 45 minutes, 55 minutes, something like that, because of that time constraint. If you are wanting something more concentrated, maybe shorter, we've got next Wise Step videos that drop right here all throughout the work week that are designed to take one financial concept, apply it directly to your financial life, so you're off to the races making wise financial choices. So if that sounds like you, make sure you hit that subscribe button, turn on notifications, and if you like the content, like the content. All right. Yeah, I needed to wrap things up. I wasn't sure if you saw that time as well. So let's pick it back up on that, and then we can get into everything else and what drove the markets, and we'll just keep her going. And I didn't mean to put you on the spot there, Kevin. I don't know if you have some of those stats right in front of you about
I
the
have
New York Stock Exchange and how many.
I have some. To me,
Or you can just say it in general.
Yeah, I mean, the most important one is there's 300 and some companies, the S&P 500, that were at 52-week lows within the last month.
Yeah.
And so it's very confusing because you think, oh, well, the market is just crushing it. And no, a very thin sliver. And the inverse will be true as well. When that very thin sliver gets crushed, it will look like the indices will represent that.
Right.
But if you're broadly diversified, your portfolio won't represent that.
You remember when, was it Apple and Tesla both had a stock split on the same weekend? And because of that, it kind of recalibrated the market and everything. They both tanked and dragged the performance of the entire S&P 500. Was that last August or September, something like that?
Yeah, I can't remember.
But yeah, we saw just a tiny little glimpse of how much just a couple of these top stocks, if they swing a little bit, it can drag the performance of the entire S&P 500 down. So who knows if we've got more of that in store at some point here.
Yeah.
All right, here we go. What drove the markets last year, and more importantly, what's likely to drive the markets this upcoming year, and what should you be doing about it? That's what we're talking about right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, go check it out. Search the Wise Money Show and subscribe to it or follow us there and rate the show as well on podcast. We appreciate that. All right, so we're devoting today's discussion to a recap of the markets in 2021 and what drove the markets and what's likely going to drive them in 2022, all to help you make a wise financial choice with your investment dollars. Let's continue recapping. We were talking about the market breadth, which is it's hard for me to say, but essentially it is, okay, when the index is moving in a certain direction, the overall market is moving in a certain direction, how many of the individual companies, the individual stocks are also moving in that same direction? And the market was battling weak market breadth all year.
Good job.
Yeah, thanks. All year. And where, okay, the market's trending this direction, but only 40% of the companies are actually moving that direction. And what, Kevin? We even finished at one point near the end of the year where it was, I think, a large percentage, let's just say that, while the market was hitting all-time highs, a large percentage of companies in the index were actually touching or had touched 52-week lows.
Yeah, I would call that a stealth bear market. And again, this is where if you were, they say concentration creates wealth, diversification preserves wealth. So if you were concentrated and you stepped up to the roulette wheel and put your chips on the right number and color, you hit it big.
Yeah.
It's not a great strategy for long-term success.
Yep.
But certainly if you had exposure, and I can assure you, all the people that had exposure to technology or the other asset classes that really performed well, they're probably not going to be shy about sharing their results with you.
Yeah. Something else that people won't be shy about talking about is their Bitcoin investments
or
their
Dogecoin.
Right. So last year was another incredible year for Bitcoin. I was thinking back on it and I was like, okay, where did it start 2021? probably started around 40. No, it started at what, 29 or 20 or something like that, and it nearly got to 70 before it had its pullback. But if you look at the performance of that, I think it just hit its 13-year anniversary or whatever. It's been pretty incredible. Now, I would call that speculation.
Still speculation, that's
right?
right.
I mean, we still just don't know, and that's fascinating. And the idea of cryptocurrencies, and specifically even Bitcoin, is fascinating. No idea if that will pan out and create enduring value. Don't know.
But of course, it's the stuff that people want to talk about, because how many people do you have to endure hearing, hey, I was up 400% last year? You know, S&P 500, 28%. What, are you kidding me? I do that in a week.
Yeah, I mean, 68 cryptocurrencies increased by 1,000% or more.
Yeah.
So Gala, Gala, was up 40,000%. So, I mean, Josh wondered why I was driving that bright yellow Lamborghini through 6 inches of snow to come to work this morning. And it was because...
That's a joke, those of you that don't know. So
it's not really funny. But so certainly cryptocurrencies, I mean, you said, you know, Bitcoin is now being referred to as digital gold. But there's been a lot of movement with cryptocurrencies. El Salvador considers Bitcoin legal tender,
right?
And so there's
and apparently there's a fight within states to preserve the citizens being able to use cryptocurrencies just as a posturing, just in case the federal government goes to ban it in some way or something like that. So it's just fascinating stuff if you listen. It's hard to listen to that stuff and not get infatuated by it. So you got to be careful. The entire crypto market apparently is nearing $3 trillion, which Apple, of course, hit their market cap of $3 trillion first week of the year, first trading day of the year, I believe. And so the entire crypto market, which is designed to be this, hey, it can't be manipulated, there's a finite amount of these things out there, is now up to almost $3 trillion. That's pretty incredible. So
yeah,
anyway.
And people say, what should my response to cryptocurrency be? And I would encourage you, if you want to, if you currently have a job and you're sitting around thinking, I wish I had a second job, then I would say start studying cryptocurrency and dip your big toe in the water.
The other big theme last year from an investment standpoint, we're not going to get into it here, maybe devote a show to it, is SPACs, which is a different way of taking a company public. It used to be thought of as a last resort way to take a company public, and it became the thing to do last year. The performance, by the way, was atrocious when you look at SPACs, but that obviously we broke tons of records for most IPOs and SPAC money raised and all that sort of stuff.
Do you see that as a sign that, again, there's just too much cash floating around out there? I mean,
absolutely.
People are pooling their money together in these SPACs. They're called special purpose acquisition companies. So the idea is you gather together millions and millions of dollars, not knowing exactly what you're going to do with it.
Yep.
And then you go buy a company, and essentially it's a way to make it a publicly traded stock then. And I don't know, it just feels like the next wave of too much cash chasing around investments that often are not good investments. And as you've seen, there have been some amazing stories of huge performance, but there's been an awful lot of stories of them not working out real well.
There's a pretty incredible story of a former Facebook employee, Chamath, or Shamath, or however you want to say it. Shamath, yeah, you say potato. But he basically left a bunch of people hanging, or so it appears. And the thing about understanding a SPAC is there are multiple levels. And so the ability to manipulate who does well and who doesn't in a SPAC is something that I really am not interested in any way, shape, or form.
So, Josh, you mentioned themes, that one of them being there just seems to be way too much money floating around out there. So to me, as we look back on what drove the performance last year and what's likely going to drive it upcoming in this year, I mean, it's hard to not think about the Federal Reserve's policies. So, I mean, last year, if you think about it, we were reopening the economy. It's easy to play Monday morning quarterback or armchair quarterback, whatever, and look back and say, oh, yeah, the economy was reopening. Of course, things were going to do well. Well, we didn't know about second wave, third wave, fifth wave, whatever. The vaccines turning all of us to zombies. We didn't know any of that. Okay. But looking back on it now, we can say, yeah, economy reopening. They printed $4 to $5 trillion and kept interest rates at 0%. Yeah, I'm assuming the market would do pretty well in that environment.
You're exactly right. And the question is, well, how much of this is just manipulated by government policy or the Federal Reserve's policy? And clearly, it's creating a lot of tailwinds for the overall market. We were concerned about it having too many dollars chasing after too few goods. Wow, I can't even get that out. Got it. But same thing happening in the investment world. Yep. There's only so many stocks that are being targeted as places to park a lot of this money, and it's driving some of the top stocks higher, as we've been talking in the last segment.
And there's no incentive to save because there's no return on the money that you put in savings.
Yeah.
So basically everyone said, I need to go risk on. And when the Fed said, hey, we're going to buy everything back in March, April, May of 2020.
I'm going to cut you off right there. So we've got more on what you should be doing with your money. That and more coming up on the Wise Money Show with Korhorn Financial Group. I thought you were just going to make a quick comment.
Dude, I looked and I thought
I'm like, okay.
I thought I saw an 8.
You did a minute before that. Oh, that's good. All right, so we'll hit more of the theme. This will be a full 4 segment, I'm assuming. So we'll hit more of the themes, and I'm assuming the themes from last year will step right into the themes for this year, which is why I bundled them together. So, yeah. What drove the markets this past year? What will drive them this upcoming year? What should you be doing with your money? That's what we're talking about. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online at wisemoneyshow.com or all over social media. Wherever you're at, we are there as well. Just search the Wise Money Show. We're talking about themes in the investment world last year, and I heard an economist share that the market went up because of Trina, which is what we were just talking about. And what is Trina? There really is no alternative. Put your money.
I thought it was her sister Tina.
No, it could have been Trina. There really is no alternative at all. And so we left off. I had to cut Kevin off here because we were talking about, well, there's so much money printed, and we've talked about this sort of stuff before. When they print money, it doesn't get evenly distributed to all areas, and it also doesn't get distributed in largest quantities to maybe the people that need it most. A lot of the money that's printed goes into the financial system, and that money then starts chasing after financial assets. This is the Cantillon effect. We've talked about this several times. And so it starts chasing after assets like stocks and like real estate and like, companies, i.e. stocks, right? And trying to preserve wealth or grow. And so, yeah, when interest rates are at 0, when there's going to be inflation, which is definitely a theme and will be a driving theme for 2022, you're looking around, this money's looking around saying, well, where can I put it? And the stock market received a lot of those dollars.
In other words, you have a bunch of investors who suddenly have extra piles of cash in their hands because the government put it in their hands. They need to do something with it, and what do? They start buying stocks. The other thing that's been driving this, though, those who didn't go invest the money spent the money, much of them.
Yeah.
And what that does is it's created a very profitable environment for a lot of corporations here in the U.S.
This is the highest profit margin ever on record in the S&P 500. So we broke the record for most sales, highest sales, and this is with a crippling supply chain and all that, and labor shortages and everything else. But in aggregate, the companies on the S&P 500 had higher revenue than they've ever had before. And of course, higher profits in a dollar amount, but higher profit percentage, profit margin than ever before.
Yep. And that's a theme that we were kind of watching for over the past year. And to tip my hand, it's certainly one that we have to pay attention to in the year to come as well. Because if you look at what investors are paying to own a slice of corporate America right now, they are essentially betting that profit trajectory is going to keep on growing. And these corporations are going to continue to be more and more profitable. Otherwise, you wouldn't justify paying the kind of prices that the stock market is fetching these days. Mm-hmm. So that will be a theme. Will corporate America, just business in general here in the U.S. continue to remain as profitable and keep on stretching into higher and higher profits in the year to come? And
then there are two sort of tangents or connections with that. And one is, will inflation erode that profit margin? Inflation would allow a company's sales to go up because they would charge more, but then their cost of labor and their cost of products, their cost of goods and all of that stuff would be higher, so it could infringe on their profit margin. To me, I think that's the greatest concern. Mm-hmm. In times of inflation, typically, the stock market should do well. It should, but it's trying to figure out some of those distortions, and it could wreak some havoc on their profit margins. And then the other thing is the supply chain issues and labor shortages. So that could exacerbate inflation, like I believe it has, but it could also slow down demand or drag out demand, and actually could help as well. Because think if we didn't have supply chain shortages and we had enough people working, revenue for these companies would have been even more. Profits would have been even more last year. And the fact that it's delayed, possibly that could help. We'll see.
Yeah, there is a school of thought that says the crimp right now in the supply chain and some of these other things actually in the long run will be deflationary. But you can't have deflation when and again, it's not perfect to say that the government's printing money. It's a little more complicated than that. But at the end of the day, if we said the government's printing, $4 to $5 trillion, that money makes its way into the system. It makes its way to the 10 richest oligarchs last year. Their net worth increased over $500 billion with a B.
Yeah.
So. And if you look at this, and again, this is a show about financial planning, not about politics, so we don't really talk about politics on this show. But the politicians on both sides of the aisle have promised, hey, there's not going to be any tax increase for the middle class. Well, I can tell you the tax increase for the middle class, it's called inflation.
Yep.
And that's much worse than an actual tax increase, because even though people's wages have increased last year, the basket of goods and services that those wages would buy got smaller. Mm-hmm. Yeah. So people's wages are not keeping up with the increased cost of life and doing things.
Anytime the Fed or Congress begin to manipulate with or tinker with the economic engine that drives the country here, they're going to create winners and losers. Mm-hmm. And of course, there's going to be outrage when too much of the winnings goes to a select few. But here's the two camps I would put this in. Those who are benefiting from inflation are those who own assets. Those who are almost being punished by inflation are those who don't own assets, and they spend most of their income on just goods and services that are going up, getting more expensive over time. And the key, though, again, this is a show about financial planning, right? Mm-hmm. How do you make choices in your financial life? How do you put yourself in a position that tomorrow can be better than today? It is by owning assets.
Yes.
And, in a high inflationary environment, it's going to benefit you in some way. You need to own investments that are growing for the future. If that's a 401k at work that you've never taken time to actually get plugged into, or you haven't been saving the right amount into, now's the time. It's the beginning of the year. This is the time to be making changes that can be positive for the future. And, it's hard to recommend to those who have been renting for a long time to go buy a house. in this type of environment. This is a hard environment to be, competing in. But you could be putting yourself in a position to be ready to buy a house when the opportunity comes again.
Yeah,
right?
it's all about positioning. And at one of the parties I was at over the holidays, someone said, "Hey, well, I'm gonna buy a house, but I'm just waiting for the market to come back down." And a good friend of mine looked at him and said, "It's not coming back down."
Yeah,
Who knows? We'll know 5 years, 10 years from now who was right. But with all of the cash that's been pumped into the system, it seems to me, from where we sit today, it seems unlikely that the housing market will come back and you could buy houses like you could in 2010 and 11.
Mm-hmm. There's an anecdote to inflation, that's a recession, right? And what typically starts recessions, a lot of them occur from policy mistakes. And I think that's going to be the biggest theme for this next year is what will the Fed do? They're tapering, they're slowing down the amount of money they're injecting into the markets, into the economy. Now, that's a far cry from them trying to pull money out. And the thought is there will be 2 to 3 interest rate hikes next year, the first one possibly being May or June. And so we'll see if they make a misstep, if the market likes that or doesn't like that, if they will make any mistakes, and that will likely drive markets quite a bit next year. The big question is then, what do you do with all this? So we've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Yeah, we're going in the 4th segment.
Okay, a recession is an antidote to inflation.
What did I say the wrong one?
You said anecdote.
That might just be the
I
big
wasn't
lips.
even listening to you. So
That
I
might
don't
just
know.
be the big lips there. Or at least my brain.
You're good.
Anyway, thank you.
Yeah, nope. That's good. Okay, so where do we want to go?
Well, let's hit action items. So get started building assets if you haven't yet. Increase how much you're putting in your 401k. Do a good old rebalance. Yeah. So really action items. So WFRN missed out on that, but I think we have to hit that. So this is all of everything but applied.
Yeah.
That's what this 4th segment is. So.
Okay, sweet.
All right. Now a good time to rebalance your 401k, or do you let winners ride? We're going to talk about that and other action items you should be taking in your investments right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard, and with me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on our YouTube channel. Go check it out. Search Wise Money Show on YouTube. Subscribe to it there. Turn on notifications so you're made aware every time we drop a new episode, but also additional content that we post all throughout the work week. Okay, so we've recapped what happened in 2021 in the markets, why, sort of the themes, and likely those are going to be the same themes this upcoming year for 2022. Rising profit margins and profit, those expectations seem to be extremely high. Really low interest rates and accommodative Federal Reserve policy, that likely is going to influence things in 2022, whether the Fed changes their tune on that or not. Inflation and speculation, obviously those played a huge role last year and will likely do so in 2022. So all this comes down to, well, then what should you do? Based on all of that, what should you do with your investments? Guys, I've got a list. I'm assuming you guys do as well. What would you share?
The first one has to be that you need to give fresh eyes to your investments and be looking at it through the lens of financial planning. Don't just look at this as, what can I do in my portfolio to give myself some bragging rights when I'm at the backyard barbecue this summer. Mm-hmm. This isn't about the short-term gains or cool themes or sounding like you're kind of in the know of what's going on in the market. No, this is about choosing an investment mix that has legs to carry you long into the future, not just this year. Mm-hmm. Right? So re-examining your portfolio with that set of lenses, I think, is important. And if that's how you're evaluating your investments, then you're going to ask yourself things like, hey, am I still in balance with my portfolio? There have been some huge winners and some laggers coming out of 2021. And, whenever that happens, when there's that kind of disproportionate amount of growth in some select areas, you have those areas of your portfolio start to kind of squeeze out or become too large of a portion of your overall portfolio. And that may be hard to hear, because why would you ever want to maybe prune back a little bit of your winners? But that's exactly what rebalancing is. It's selling the stuff that did really well so you can buy the stuff that's cheap right now. And it's one of the most disciplined things that you can be doing. It's something that you need to do at least probably semi-annually. Maybe even more frequently than that.
And when you talk about rebalancing, a lot of times we're talking about what's in your retirement accounts, what's in your qualified dollars on that side of the ledger.
Yep.
Because on your non-qualified, if you are doing rebalancing on the non-qualified side, it's likely you're going to create some sort of a tax event.
Yep.
So this is why you want to be working with your certified financial planner who is working on the strategy and then can also help with the implementation between your investments and your tax plan. Because not only would I rebalance in my qualified investments and look very closely at my non-qualified investments, if in my non-qualified investments, if I had any outsized winners, any big gains, I would look at what I'm planning on doing this year for charitable contributions, and I would move some of those highly appreciated assets into a donor-advised fund and sell it right now. And I wouldn't make my contributions anymore with cash out of my own pocket. I would do it out of my donor-advised fund.
Yeah. I agree. Right now is the time to look at rebalancing, number one, or number two, because number one is, am I taking the right investment strategy, investment approach for my overall financial plan, my overall financial life? Are you taking more risk than you should right now? Mm-hmm. You're a year, possibly 2 years, if you were unsure what to do since the pandemic and economic shutdown with your investments, 2 years closer to retirement. And because of all the change and everything that's happened, maybe you're hoping to retire even earlier, as we've seen a lot of people do. And all of that influences what approach you should be taking with the risk level of your investments. I would also look so markets climb a wall of worry. Well, then what? I don't know. What's the market worried about right now? It seems more so that where even 6 months ago, 12 months ago, the common theme was market worry and concern. And right now it seems the opposite of that. And so I would make sure that you've got a multidisciplinary strategy in your investments, holding both a diversified mix, but also a momentum or a strategy that has a sell discipline or some sort of mechanism to adapt if and when needed.
Absolutely. Another financial planning application to this whole concept or topic from today is really reevaluating whether or not you are saving enough for your long-term goals as well. And if you just received a pay increase coming into the new year, or you're expecting to have your wages increase, the risk is that you let your lifestyle, your spending creep right along with that. And that may not be entirely up to you. I mean, all the things that you spend money on at the grocery store and whatnot, it is getting more expensive, right?
I can't afford chicken wings. I don't so when I go out to dinner or we go out to eat, I don't buy chicken wings anymore. They are so stinking expensive. I remember those things you could get 50 cents a wing. Sometimes on a special, you get 30 cents a wing. It seems like they're $3 a wing right now. Yeah, it's insane.
It is crazy. So life's getting more expensive, and that's kind of the point, right? Out there in the future, life will be more expensive as well. And if you were planning on living off of a fixed income, you are getting squeezed now and in the future. And so your savings plan, your goals and everything have to be reevaluated.
Yeah, because wings don't cost more right now. They just don't. They went from 50 cents to $3. Wings don't cost more. The dollars that I'm using to buy wings are worth less.
Because there's more of them out there.
Because there's more of them out there. And that's what and a long time ago, a good friend of mine, as I was talking about my concerns about the deficit and all of these things said, no, don't worry about it. We're just going to inflate it away.
Yeah.
And I thought, well, what do you mean? And I'm like, well, if we are able to create inflation such that your Social Security check will only buy a tube of toothpaste, we're not really worried about $30 trillion of debt.
Well, on that optimism, from an investment standpoint, guys, what do you do with bonds? Like gosh, I remember, I can't place the person who said it, but someone said the 60-40 portfolio is dead. Oh yeah, it got some
that may have been you.
backlash. Got some backlash from his co-host here on the Wise Money Show. But the 40 struggled. The bonds actually, they were underwater all year. And again, a bad year for bonds is nothing. That's a bad day in the market. Okay, so nothing to be afraid of there. But with the likelihood that the Fed's going to increase interest rates and all that, what do you do? What do you do with that size of your portfolio? That side.
Yeah, if you're using the way you used to do it, you might need to make a change. Because when you look, you say, well, what would cause bonds to be negative? Well, if interest rates go up, bond prices go down. And so it's not much more complicated than that. And what the Fed is saying, you said, Mike, what does the market have to worry about right now? And I am an optimist, but I would encourage you to think about the market worrying about potential interest rate increases and the Fed stopping buying somewhere between 120 to 180 billion dollars worth of bonds per month. Mm-hmm. And so, because what that has done, if you look at any kind of charts, anytime a line goes straight up, it's not to be believed. Mm-hmm. And I could make a case since March of 2009 till today, the line has, in essence, been straight up.
And from March of 2020 to today, I mean, that's about as straight up as it gets.
Yeah, that's
going
popping
back
a wheelie.
all the way to the Great Depression, like right before the Great Depression. So, yeah, I would rethink your strategy for your bonds. We talk about having a sell discipline or a momentum strategy. Last year, if you were in stocks, then the winners was the S&P 500, mm-hmm. right? If you were in any active strategy, you lost. It was an awful. One of the funds that we've used is from a very large institution and was up well over 100% in 2020 and was flat in 2021, which you'd say, how is that even possible? Well, it was.
But that happened all over the place.
Yeah.
I mean, if you look at all the investment themes coming out of 2020 into 2021, the winners became the losers the prior year became the winners. It was like a complete reversal on what was working, and that may continue to happen in the years to come. So don't just plug yourself into one strategy and stick to it blindly. You need to have a diversified approach, and you need to be revisiting it regularly.
Yeah, and don't just look at your 401k and say, what won last year, and now I'm going to move money into that because the one that the several funds that I'm in my 401k didn't win last year, so I'm going to move them into last year's winners because they'll win again this year. It reminded me of when my son was born. My first son was born in February of 2000, and I looked back at 1999, and Invesco Technology had been up 120%. And I thought, well, if I put some money in this fund and it only does half what it did last year, I should be fine. And needless to say,
the investment was cut in half. Is that what happened?
Not the return, the investment. Okay, but going back to bonds, a momentum or a diversified or an active strategy in bonds might really be helpful. There's inflation-protected securities, something like that. That might be something you want to consider. High yield, something like that. But just buying bonds and letting it sit right now, that would be tricky. So I'd evaluate your strategy there. We've talked about it as well, but I'll just say it pointedly. I would increase what you're contributing into your 401k right now. Ideally, you're taking a look at your retirement plan and saying, am I contributing the right amount for my plan and my goals? And if the answer is yes, and you still have excess resources, you might say, well, I'm going to contribute even more than I need to towards my retirement goal, just in case something changes or whatever, right? But certainly if you haven't done that math to see if you're on track or not, or you already have it and you're short, increase what you're contributing to your 401k right now. Buy more assets.
Yep, I love it. One of the greatest investments that you can make this year, though, is in yourself and your own education. And I think that's an important theme, especially at the beginning of every year. Set some goals on how it is that you're going to understand your financial life better this year, because that will reap the most important dividends and rewards for you in the years to come. So I hope that this time next year, you are even more savvy when it comes to your financial life because of the investment of time and energy into understanding your life a little bit better.
Yep. I've had several people just already this year reach out who we've served in the past providing financial wisdom, and that relationship has morphed into us just managing investments, and had several right at the beginning of the year that reached out and said, I got to get started on planning again. It's like, yes, you do. Let's get a meeting scheduled with the team. So hopefully this helps spur you on in that direction and you're making wise financial choices. All right, that's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.